Hey everybody, it's Adam Haney, and I wanted to bring this market recap to you here as I recently listened to a video conference with former Secretary of Housing of Urban Development, as well as a mortgage banker in New York City, as well as the top, if maybe the premier mortgage market expert in the entire country. And the main topic of this video conference was loan servicing, or more to the point, assistance for loan servicers during this period of COVID-19 and loan forbearance. So what I want to talk about is really three things. First is forbearance, then loan servicing, and then kind of wrap up with the current state of the mortgage market and real estate market. So for starters, forbearance. It's here. April is the first month that homeowners are allowed to go into forbearance and defer that first month's payment. The forbearance period is going to last for up to 12 months if borrowers need it for that long. And I've said this before, and I want to reiterate it again, that forbearance should really only be used as a last resort. For people who maybe if they have lost their job and simply have no other means of income to make their payments, then yes, sign up for forbearance and take advantage of that. But for others who can't afford to make their payments, but are looking at its forbearance as maybe just a nice way to have some additional cash flow over the next 6 or 12 months, I don't recommend it, because even though forbearance is not going to ding somebody's credit and there are not going to be late charges or penalties, there will be unintended and I believe undesired consequences of borrowers who go into forbearance. And that will probably be something along the lines of making it more difficult for borrowers to get a loan in the future, whether that's a loan to refinance into a lower interest rate or possibly to buy another home. So again, I don't suggest going into forbearance unless it's really no other option. The other thing that I wanted to point out is I've had a few clients come to me and say that they had contacted their loan servicer just to find out about forbearance, not that they actually wanted to sign up for it, but the next thing they knew, at the beginning of this month, they had received a letter saying that they were approved for forbearance. So because this is all happening so fast and furious, do be careful. And if you have inquired about forbearance but don't really want to sign up for it, make sure that you didn't get put on the list to all of a sudden receive forbearance if in fact you don't need it. So the second thing I wanted to talk to you about is loan servicing as it pertains to forbearance, because as I mentioned in previous videos, the loan servicer is just that. They service the loan. That is, they collect payments from the borrowers and then they send those payments to the end investor, the owner of that loan, which in most cases is Fannie Mae or Freddie Mac. And so the loan servicer doesn't actually own the loan. They're just simply servicing it. And for that servicing, they pay a fee to service the loan. And then for servicing that and servicing the borrower, they collect a fee. But the way it works with forbearance is that even though homeowners are given this period of up to 12 months to not make their payments, the loan servicer is still on the hook and responsible for making those payments to the end investor, in this case, say Fannie Mae. So on the video conference, it was estimated as high as $650 billion worth of mortgages that have gone into forbearance, that loan servicers are not receiving payments from borrowers, yet still obligated to make the payment to the end investor. And loan servicers simply cannot afford to do that. So the crux of this call, this video conference, was about putting pressure on FHFA, Federal Housing Finance Authority Director Mark Calabria, to come up with some kind of a solution to help loan servicers. So Director Calabria had put out a statement on March 18th that said, with regard to forbearance, quote, "This foreclosure and eviction suspension allows homeowners with an enterprise-backed mortgage, that is Fannie Mae or Freddie Mac, to stay in their homes during this national emergency. As a reminder, borrowers affected with the coronavirus who are having difficulty paying their mortgage should reach out to their mortgage servicers as soon as possible. The enterprises are working with mortgage servicers to ensure that borrowers facing hardship because of the coronavirus can get assistance." So that's a good thing. Borrowers are getting assistance. Who's not getting assistance are the loan servicers, and they're really the ones on the hook for making these payments. So the brunt of this conference was to add additional pressure, if you will, encouragement to Director Calabria to come up with some kind of a solution. Now, it's going to be primarily for agency-backed loans, or I should say enterprise-backed loans, which would be the enterprises of Fannie Mae and Freddie Mac, which are government-sponsored enterprises, as opposed to Ginnie Mae, which is a government agency. So Ginnie Mae, fortunately, has come up with a solution on this already. Now, Ginnie Mae handles government loans such as FHA, VA, and USDA. So Ginnie Mae is under the Housing of Urban Development. So they're already a government-backed entity that insures government loans. So consequently, perhaps it made it a little bit easier for them to come up with sort of a pass-through strategy assistance to loan servicers who are servicing government loans. Again, that being FHA, VA, and USDA. So that the servicers know that even though they may not be receiving payments from these homeowners for a while, that Ginnie Mae is going to help them out with that. What needs to happen is a similar type of arrangement on the conventional side, conventional meaning Fannie Mae or Freddie Mac, where the FHFA, Federal Housing Finance Authority, headed by Mark Calabria, will give loan servicers the same type of assurance that they will receive some kind of assistance to help make these payments to Fannie Mae while homeowners have their payments in deferment. And so far, that assistance has yet to come about. And the reason is uncertain why they're doing that, but one thing is certain, that loan servicers simply cannot afford to cover $650 billion worth of homeowners' mortgage payments. On top of being expected to make new loans for homeowners who are maybe trying to take advantage of lower interest rates, or make loans for people who are trying to buy homes. They simply can't do it. And if the loan servicers don't get some kind of support from some sort of facility to help make those payments, the consequences of that would be catastrophic through our entire banking, not to mention just the mortgage sector, but the entire banking sector as well as real estate. So it would cascade throughout the entire financial services and be horrendous, catastrophic. It would be so catastrophic that it's almost a foregone conclusion. One would hope that something has to be done and that something will be done. But so far, something has yet to be done. And loan servicers are really starting to feel the pinch, the cash crunch on this. So how have they reacted? Well, let's just say, for instance, that these loan servicers who are also making loans are making loans within the parameters of what Fannie Mae, Freddie Mac, Ginnie Mae allow. And let's just say Fannie Mae, Freddie Mac, Ginnie Mae say, all right, these are our guidelines. Anything within this parameters here, any credit scores within this range, any debt ratios within this range, any cash reserves within this range are good. We'll take these loans. But with loan servicers now potentially on the hook to make billions of dollars worth of payments for homeowners who cannot make their own, loan servicers are adding overlays and they're tightening their guidelines. So even though Fannie Mae and Freddie Mac and Ginnie Mae are saying, we'll take loans, anything in this range, loan servicers are narrowing it and saying, we're only gonna do loans within this range. This here is the cream of the crop. These loans have the best credit scores, the best debt ratios, the best reserves. These are the borrowers that we feel aren't gonna leave us on the hook for making their mortgage payments for 6 or 12 months, or whatever the case may be. So these are the loans we feel safe making, even though Fannie Mae, Freddie Mac, and the other guidelines allow for loans out here on this periphery. So these borrowers that are out here in the periphery are kind of out of luck. And that means maybe they can't get a refinance after all, assuming that, of course, that they are still working. But if they are working, but their credit scores don't meet the guidelines of the overlays investors have imposed, or loan servicers have imposed, or the debt ratios are a little bit higher than what they want, or the reserves aren't there, those people are not going to get a loan. And the consequence of that is that it's going to make it harder for people to buy homes. So less people are going to be able to afford to buy homes, and therefore there'll be less homes sold. And of course, that's going to have an impact on the housing market at some point. So again, we're simply talking about loans that meet Fannie Mae, Freddie Mac, and Ginnie Mae guidelines. If it's a loan outside of those parameters, such as a jumbo loan, well, jumbo loans have all but dried up. It's practically impossible to get a jumbo loan right now. Now, you may, a borrower may, be able to go to a bank directly and get a jumbo loan, but it is going to be painful, and there better be nothing wrong whatsoever with that loan. Better have excellent credit, better have at least 12 months, if not maybe 18 months worth of reserves, very low debt ratios, basically absolutely no foreseeable reason whatsoever why that borrower could potentially go into forbearance and leave that loan servicer on the hook for making those payments. So again, jumbo loans have basically been put into suspense. So if there was a borrower who was trying to buy a property relying on a jumbo loan, they are probably out of luck. And so you could imagine what sort of impact that has on our housing market. Now, one of the experts had predicted this sort of credit crunch would potentially cause home prices to maybe contract by as much as 5%. Again, probably more directed towards higher end homes, but even homes in the entry level, according to this one expert, he thought could see a 5% correction, because if people are being laid off of work, or if these tightening credit guidelines are keeping people from buying, it's going to have an impact on real estate prices. Now, two of the experts, however, felt that we're more bullish, more optimistic about home prices. And they felt that particularly with regard to entry-level homes, they are well supported. Purchase prices, I should say, are well supported in that range. And that especially with the low interest rates that we have right now, for those borrowers who can afford a mortgage, it is making it very affordable because we have these low interest rates. So whatever the entry-level price range may be in a particular area, those are expected to fare well throughout this situation that we're experiencing. But again, the higher priced homes and the jumbo probably going to be taking more of a hit. And so those are the types of things that we need to be aware of at this time. And so what came out of this video conference, one of the top suggestions was, to write your congressperson and suggest, implore that they put more pressure on Director Mark Calabria, director of the FHFA, to do something, and do something quickly to aid the loan servicers. Because if they don't get it, it is just tightening and tightening and tightening the cash crunch, and making it harder and harder for people to buy homes, people to refinance. And so we need a solution, and we need it quickly. The other thing that I wanted to point out is I heard there was one realtor who had come up with a marketing flyer suggesting, hey, now's a great time to buy a home, because buy a home and then you don't have to make any payments for 6 months, which is shocking. And that is not a good idea. And it's not a marketing suggestion. If someone is a realtor, it's not a home purchase strategy. If someone is looking to buy a home, that would be a terrible idea, because, well, for one, it's fraudulent, but two, it just puts that much more pressure on the banking system. And I think that kind of a flyer or strategy has really put someone at risk of probably losing their license. But again, if you are hearing of strategies like that, such as buy a home now because then you don't have to make a payment for 6 months, just forget that you ever heard that, and don't think that is a legitimate strategy, because probably ultimately you'll get yourself in a lot of trouble, a lot of hot water for that. But what you can do is, like I say, write your congressperson. We need more assistance from the FHFA to do something to help our loan servicers, to really help the health of the entire mortgage industry. So I hope that helps. And of course, if you have individual questions on a scenario, please don't hesitate to reach out to me, and I look forward to working with you. In the meantime, hope you stay safe and stay well. Thanks.